our starting point. That is a trade alert. The aforementioned Stephanie Link just made a big trade in the energy patch. That is the company formerly known as Schlumberger, SLB, sales up 13%, GAAP EPS up 14%, net income up 14%. And you're buying more.
It was a good quarter. It always trades off.
That sounds like a good quarter.
It always trades off on the quarters. I don't know why, because all the numbers you just cited, right? I mean, you have earnings up 19%, and you have revenues up 13%, adjusted EBITDA up 15%. They're talking about the cycle being elongated because of their pipelines are so much stronger than what they expected in terms of business. And so that, to me, when I heard that on the call, I'm like, this is silly. It's down 21% from its highs, and it trades at a very attractive valuation of 14 times forward estimates for the number one player in the industry.
Okay, so I spoke with the CEO, Olivier Lepouche, at the Zero. Did you like that?
Olivier Lepouche. That was a great interview.
He's like it's a James Bond name.
That was a great interview.
And thank you. It's about a month ago, and he was bullish on pretty much every segment of their business. They've got this. And I'm always skeptical when they say we're transforming, Joe. It's a digital, we're a software. Everybody says that. But the numbers do seem to confirm that move, and yet it doesn't get a lot of respect from the markets.
No, it certainly doesn't. We're going to get a lot of energy earnings next week. You have Chevron, you have ExxonMobil, you have Hess, Valero, Halliburton. So we'll hear the story. But, you know, I think there was a degree of skepticism surrounding oil heading into the quarter. We've gotten the lift. A lot of it is certainly on the Mideast tensions. But the overall environment, look, we've disincentivized the growth of production. We're seeing that demand is beginning to slowly rise. And I think from an asset allocation perspective, for the very first time, investors have to think to themselves, maybe this is different. Commodities aren't a boom-bust cycle. Maybe commodities are entering a phase, a secular phase, where they belong in investor portfolios, maybe single-digit portfolio allocation. But I think we're entering that type of environment because that demand versus supply imbalance, I think that's staying with us for many years.
Well, what's also staying with you is free cash flow. I mean, these companies are generating an enormous amount of free cash flow, and they're not pumping it into production. Yes, they are doing some of that, as they should, but they are returning it to shareholders, and that's exactly what we have wanted from these companies, so that you don't have these boom-bust cycles.
Obviously, energy is my jam, as they say, and I want the audience to know. I did not stack the show to start with energy today. It was our executive producer's decision, but I think it was the right
important today.
It was the right one. It was important. And you said something interesting. You said the word phase, and you were talking about phasing in, which is interesting because a lot of people are going to be surprised, Bill, that we heard a lot, and I don't want to get political, but we heard a lot about phasing out fossil fuels, right, during the previous campaign. All right, I want to be very clear. Even the most bearish estimates, which is the International Energy Agency, which has been wrong, has oil growing the next number of years and possibly next number of decades. That's the most bearish. And yet there is this mind, I think, investors have, Bill, that, oh, well, they're going away, so why invest? They're not going away. Oil demand growth is only going up.
Yeah, it's true. And I like the phrase, petroleum runs the world. There are so many products that are made and derived from petroleum, it's not going anywhere. Now,
the body of a Tesla is made from plastics and natural gas derivatives.
Yes, yeah. I mean, it's really a great thing. From where I'm looking at it right now, we're 10% energy, and we've been leaning into it, really leaning into the refiners. We did get out of Schlumberger, I think, in January ahead of that earnings report because I was a little bit nervous about how it would react after the earnings report. And as you said, it hasn't always acted great, even though they had a great quarter. If I was going to add another name outside of the refiners right now, I would lean into SLB. One thing I am making note of mentally, as I am overweight at 10%, you have to be cautious. Is oil heading into maybe a seasonal top towards the end through Memorial Weekend? That's typically where I would look to see maybe a stall. The refiners are leading some downside, but the refiners have had these big spikes, and then they consolidate, and then they could spike again. So that's what I'm watching right here. But, you know, we did have the geopolitical spike in oil last night. Does that bring a short-term top? So I'm just cautious right here as somebody that is overweight.
So I want to caution the viewers because I think what happens is that the viewers see the price of oil going from $86 overnight to below $83, and automatically they say to themselves, okay, well, oil's failing here, and therefore my investment in energy equities I need to reduce those allocations. And I completely disagree with that. Do not look at the spot price of oil as the ultimate referendum on what you're doing in investing in energy.
Why not?
You have to look at the long term. You have to look at the long term and think about the secular change that I identified in my opening remarks. Look, you want to talk about oil, the front month expires on Monday. It is in backwardation. If I go 12 months out, you're talking about $75 oil. If I go 24 months out, it's $70 oil. If I go 36 months out, it's $68 oil. In the near term, Brian knows this well, June 1st is a big OPEC meeting. At that point, we're going to hear a lot about the potential to lift some of the curbs. Saudi Arabia needs to lift the curbs. They're running a fiscal deficit. Their economy last year was in contraction. They need to pump more oil above the 9 million barrels that they're pumping today. So in the near term, there could be some headwinds on price itself. But as long as price is staying in that $70 to $85 range, that's so beneficial to these companies on the free cash flow that you talk about.
The cash flow break-evens at Exxon and Chevron is 35 for oil. That's where they make money. That's
agree.
So obviously, anything above that, it's just great.
And a lot of analysts, from Morningstar to other banks, they are marking these names at 60 in the 60s, not even above 70 on oil. So as long as oil stays there, the free cash flow is going to be generated at a higher pace than expected.
I should be, pending some unexpected circumstance, be at that OPEC meeting, which, thank you, OPEC, is over the weekend again, because it is so critical, to your point. Saudi's 2 million cuts, 6.6 million spare barrel capacity. We'll see. Very quickly, we're going to move on in a second. Bill, I do quickly, is 80 to 85 really the sweet spot for oil? It's enough to print that free cash flow Stephanie was talking about, but not high enough to cause demand destruction on the gasoline side.
I do agree with that. I think the 80 is the sweet spot. Technically speaking, 78 was a big resistance that now we broke out above. And if we could settle in here above there, I think that's going to be a really great for the cash flow of these equities that you speak of.